Okay, now we're going to talk about a few things. There are other ways that companies use, other factors that corporations use sometimes to evaluate projects. And I'll talk about those in a moment. But this discussion is going to be focused around why net present value is the best one. Okay, so I'm giving away the secret already that net present value is really better than the other ones that are currently being used. Let's talk about those for a moment. So what do people use to evaluate projects other than NPV? Well, some companies use something called the book rate of return. The book rate of return is simply the book income divided by the book investment to come up with a return. Now, as we talked about earlier, that books and tax are significantly different, and your book investments can be much different than your actual investments. So that generally doesn't give you a very accurate result of your actual return on that investment. The other criteria people sometimes use is what they call project payback period, or we call it PP here. And that is simply how long does it take for the cash flows of the project to return back to the corporation the investment cost. That's called project payback period. Then the third way of evaluating investment criteria, or the other investment criteria that are used, is something called the internal rate of return. Now, book rate of return, BRR, and payback period have little to do with whether or not this project increases the shareholder value, because of what I just said a minute ago. But I'll show you more details about this in a moment. But in the IRR, interestingly enough, IRR should always identify projects that increase the wealth of the company. If you know what some of the traps are around using IRR, and you can use the IRR correctly so you don't fall into those traps. Let's look at these three criteria a little bit more. But I want to revise or go back and do a little bit of revision of what we talked about already. Don't forget, points to remember when you're talking about NPV. $1 today is worth more than $1 in the future because you can invest it right away. The net present value calculation, if you remember, depends solely on the forecasted cash flows and the opportunity cost of capital. So, we can argue that the forecasted cash flows are variable or can be played around with. But let's assume that you make a reasonable forecast and then you know the opportunity cost of capital. So there's no real variables there. So that's a big thing versus the other ways that people look at this. And remember that because net present values are calculated based upon the value today, right? We're calculating back to today the value of a project. They are additive, meaning that it's unlikely that you'll be misled into investing in a good project that has a very positive NPV and one that's not so good or maybe even has a negative NPV by having somebody try to bundle them together, and which may still generate a positive NPV. But if you look at the fact that each project is considered independently, you would make the investment in the one that has a positive NPV and not make the one that was a negative NPV. Okay, so that's just to remember, keep in the back of your mind. So again, the book rate of return, that's equal to the book income divided by book assets, which I've already said. But cash flow and book income are very different, right? Cash outflows are classified as either capital or operating costs, right? So capital costs are put on the company's books and depreciated. So if I'm looking at the book cost of this project, it could be zero because there's no cash outflow because I'm capitalizing it on the books. Operating costs are deducted from book income. So there's lots of things that are going on that makes book rate of return not a real meaningful way to look at investment proposals, because it depends upon what's capitalized and what's not, and at what rate of depreciation you're using to amortize that expense over the life of the assets. So that's book rate of return. We'll talk about the other ones next time.